You are listening to Keystone Stock Talk Show, episode 311. It's great to chat with you again this week. I kick off the festivities with a look at a unique marriage made in stock market heaven, small cap dividend growth stocks, highlighting Hammond Power, Boyd, and a potential next small cap dividend growth stock. Brennan answers a viewer question in our Your Stock Our Take segment on NameSilo Technologies, symbol URL, on the Canadian Stock Exchange, a lower cost provider of domain name registration and management services. The microcap has been on a tremendous run, and Brennan lets you know what is driving this boom. Brett takes a look at recent IPO Klarna Group's, symbol KLAR, on the New York Stock Exchange, a Swedish fintech company that provides buy now, pay later services. While a recent IPO, the business has been around for around 20 years. Brett lets you look, or he'll take a look at the historic fundamentals to see if they back the IPO valuation. All right, let's get into the show. I welcome my co-host, the Killer Bees, Brett and Brennan. How are you guys doing? Good weekend?
Doing well. You betcha.
Doing well.
Yeah. September is always an underrated month, I feel like. I mean, I'm sure that it's still, blazing hot where you are, Ryan, because of course, it's always
I don't know if it's blazing, but yeah, it was 20 some degrees this week.
Yeah, same nice. Here. We kind of, had a nice
We heard
weekend.
You baked a pie though.
Yeah, I did bake a pie. Well, I mean, let's be honest, it wasn't me. It was my girlfriend that baked a couple pies.
Did you chop anything?
I chopped the apples. But it's funny, like, she sent me to the grocery store to go and buy things. Mm-hmm. And of course I needed like pictures and everything. But of course, while I'm at the grocery store,
pictures of what an apple is. Yeah.
Basically, well, this was the thing. I called her the first time. I called her the first time. I was like, they don't have the apples you want. What kind? So it was like, okay, humming and hawing. Within like 5 minutes, I was calling her back and I was like, hey, they don't have the size of pie sheets that you want. What should I do? And she basically is like, Brennan, what do you think you should do? Yeah. So next time I'll just bring back the wrong thing. And yeah.
Good. Excellent. Well, was the pie good though?
It was two
pie. Did you do pumpkin and apple?
Yeah, pumpkin and apple. Yeah, for a Friendsgiving, and it was a hit. It was pretty good.
Say that again. For a what?
For a Friendsgiving.
Friendsgiving. That's good.
You've never been to a Friendsgiving before?
I don't have any friends, so I need that to have a Friendsgiving. Yeah, no, that's impressive. I'm sure it was great. Mm-hmm. Let's get into the show. We've got a poll that we can look at last week, and the poll dovetails into some commentary we've got.
Yeah, so the poll was, do you feel better about your financial situation compared to 1 year ago? 67% of our viewers said yes, better. 21% said about the same, and 12% said no, they are worse, which is quite opposite compared to some of the finance. Because a couple of weeks ago, we asked about just the economic scenario. Are you feeling good about the economy, or do you expect it to improve? And we had the reverse results. People are expecting the negative side, and now we're seeing the positive side.
Yeah, so they I think they're maybe referencing their portfolio here more than.
I think so, and that's probably what it is they're referencing their portfolio, because I agree. I said yes. My portfolios went up in a straight line this year. You can't expect that every single year, but it's been doing well. And this kind of comes on the back of a report that came out saying optimism on personal finances hits rock bottom, and it ties the record since tracking started in 2008. And this is by Nanos Research. And they essentially did a poll, essentially asking, thinking of your personal finances, are you better off, worse off, or has there been no change over the past year? 10.6% said better off, 39.5% said worse off, and 48.1% said there has been no change, and 1.8% said they're unsure, which I always find is a little funny. But it's exactly the opposite.
Those people just can't make a decision.
They just can't make a decision.
I don't know. Stop asking.
we're seeing the stock market perform well. Like, this poll question that we did on YouTube, obviously, people are feeling it, positive in their portfolios. But, economically, people are still, a little bit worried. The another question that they had in this survey here, they said, thinking of the upcoming year, do you think the Canadian economy will be stronger, weaker, or there will be no change? 19.3% said stronger, 45% said weaker, 26 or about 27% said there will be no change, and again, 9% said I don't know. Yeah.
Yeah. I mean, I think it's not surprising where you've got this. I think we talked about last street. You got a divergence from Main Street and Wall Street. You got Wall
Yeah.
Street doing tremendously well. Main Street, you got inflation impacting everybody's bottom line.
Yeah.
Every time you go to the grocery store, everything seems more expensive. It's squeezing the wallet. And, and then on the flip side, you've got the stock market going gangbusters this year, or even over the past couple years, really. So, it's interesting. It's not everything in the stock market is moving either. You still have to be quite selective. I mean, we was it last week or the week before? I did a segment on a tale of two retailers, right? And we talked about Lululemon being a tremendous brand, but being down 50% in the last 6 months. It's over 50% now. So you're getting you had 100,000 in that, you're down to 50,000 in 6 months. Juxtapose that with Group Dynamite, a recommendation of KeyStone's at the start of this year. It's up almost 300% this year. So same, started with women's clothing. I mean, and that's still where Group Dynamite is, but certainly where Lululemon started. You've got a tale of two situations there. If you were invested in one, the more well-known name, you lost half your money in the last 6 months. The next, you're up 3-4x in the last 6 months. So, interesting. It's certainly not everything going in a straight line, but the right companies are certainly doing well right now in the market. So it's good to see. A little bit more cautious in the near term, certainly in terms of where valuations are. So. Is there anything else you want to do on the poll or talk about in terms of Main Street versus Wall Street, or should we just get into the show, the meat, the order?
We can go into the meat pie.
Should we talk about the Blue Jays? You guys.
I mean, I wasn't watching, but my dad was. So I mean,
yeah, they clinched a playoff spot. Clinched a playoff spot, and now what they really need to do is win the division. So they need to beat out those terrible the Yankees, and if they can beat out the Yankees, they can win the division, and then they've got a bye in the first round. That's very much needed, and then we can move forward. But I mean, like I said last week, the only thing that we cheer on the West Coast here that comes out of Toronto is basically, well, I guess the Raptors too. When the Raptors are doing well, we're there because we have one NBA franchise. In Vancouver, we feel a little jilted because we lost the Grizzlies, but certainly the Toronto Blue Jays unite the country. There's only one Major League Baseball team in the country. All right. You guys got nothing on that?
Go sports. Hey, Brett. Go sports.
Go sports.
Just awesome. Okay. I'm going to move on to share my screen here, and then we're going to talk about a unique marriage here, small cap dividend growth. So I'm going to look at a unique strategy, small cap dividend growth stocks. I call this a hybrid approach. Now we have 4 core areas of our research. 2 of the areas are highlighted by growth stocks and dividend stocks. Some of our clients and many more in the investment world at large tend to mentally put each investment into different categories. It's kind of a distinct categories to kind of fill different needs in their portfolios. Dividend stocks for income and growth stocks for, growth. Similarly, investors tend to associate dividend stocks with larger stocks or dividends with larger stocks and ignore small cap dividend stocks. To a degree, this is reasonable, but over the years, we have found that best dividend stocks are dividend growers, and many of the best growth stocks pay growing dividends. So enter this hybrid approach, that unique hybrid approach, giving you the best long-term growth in your portfolio. Those would be dividend growth stocks. So let's take a look at the data for this unique hybrid approach involving small cap dividend growth stocks. First, I'm going to say, do dividend stocks, just dividend payers, do they outperform over the long term? Well, here is some great research from RBC on that subject showing the significant outperformance of dividend growth stocks over the long term. Let me provide a brief explanation of how this data is and graph is put together here. Dividend growers, it includes dividend payers, dividend cutters, and non-dividend payers on the TSX Composite Index. It's sourced annually. Dividend growers represent stocks with a positive 12-month change in dividends paid. Dividend payers represent stocks with a dividend yield greater than zero. Dividend cutters represent stocks with a negative 12-month change in the dividend paid. And non-dividend payers are stocks that have a dividend yield of zero. They don't pay a dividend. As we can see, dividend-paying stocks significantly outperform the TSX index itself from 1986 to this past year of 2024. But it was dividend growth stocks that handsomely outperformed all. 10.9% annual return versus the index at 6.5%, 68% higher, and over 5.5 times the annual payment of dividend payers, or the annual return of non-dividend payers on the TSX. A bit of a shocking outperformance when you look at it. The great thing is that dividend growers not only have outperformed, they have done so with far less volatility, as we see here. The data just shows they are far less volatile than dividend cutters, as we would expect, non-dividend payers, and the index overall, and as well as just dividend payers generally. So we have proof that dividend growth stocks outperform over the long term. Let's look at a universe of profitable small caps to see if they can give us the tremendous growth we crave from equity investments. This is a recent study. I've highlighted this a number of times. Here's the data. It's a recent study of 10x stocks, or stocks that have gone up 1,000% or more globally over the last 10 years by Jenga Partners. So what were the commonalities found in this group of great 10x stocks? 87% of global equities that went up 1,000%, 10x or more over the past 10 years started as micro or small cap companies. 82% of those were profitable at the start of their ascent. 91% had a history of profitability. So here in our small cap area of research, the key is small, profitable, and unknown. I tried to make that into one word, smallfitable. Now, this is why we focus on profitable dividend or small cap stocks. And we're trying to marry those now. So you have two areas where we see long-term outperformance, dividend growth stocks and profitable small caps. Can we create the best of both world investment? Of course we can. That would be enter the small cap dividend growth stock. The theory behind this strategy is best illustrated through real world examples. I'll give you two case studies demonstrating how patient investments in two small cap dividend growth stocks have generated extraordinary returns, not just good returns, extraordinary returns over the long term. The first company I'm going to talk about is Hammond Power Solutions. Hammond Power is a prime example of a small cap dividend growth stock. Even if we just look back 5 years, we have recommended this company for over 25 years now. A business that, while not flashy, it operates in essentially a foundational industry, a leading manufacturer of dry type transformers. The company's products are critical for electrical grids, data centers, manufacturing in the rapidly growing renewable energy sector. The vital role has made it a resilient and enduring business. For KeyStone investors who have followed that since our initial buy at 60 cents, it has returned around 20,000%. Even for those who came to the stock more recently, the results have been extraordinary. We re-recommended the stock in 2020 at around $6. Over that period, if we talk about dividend growth stocks, this is a tremendous example. You can see here, the company's dividend has grown by 223%, culminating just in the last 5 years at a return of just under 2,000%. A tremendous example, small cap dividend growth stock. The next company I would highlight is a small cap dividend growth stock. It illustrates also the power of consolidation. That is Boyd Group. It's an auto body repair consolidator. Growth story is driven by relentless expansion strategy. Since 2008, the company has grown from around 250 locations to over 1,000 across North America, fueled by this has fueled phenomenal total returns for shareholders. Again, tremendous returns over the long term, as you can see here. But the dividend itself alone has produced tremendous returns over that time. And the effective yield now on that dividend is around 26.6%. Continuous stream of income that continues to grow regardless of the daily stock price. So we're always looking for the next small cap growth stock. These are two examples of two dividend growth stocks, boring businesses, but we married that strategy. Dividend growers outperform over the long term. Profitable small caps are great areas to find 10x returns. Now, if we can put those together as we did in those businesses, can we find the next great dividend growth stock? Could that potentially be Dynacor Group? Well, over the long term, it will show us over the next 5 to 10 years whether it can be. You can certainly see the compound annual growth rate in the dividend of this, what relatively unknown small cap over the past 5-6 years has been 23.3%. So tremendous growth in the dividend there. This strategy seems boring. It's not. It's a great way to get rich with less risk and less volatility. I say sign me up for that, Mix. And there's our disclosures.
Yeah, I mean, I went through another one or another stock from our coverage in the recent 10x webinar that we did, where this company is growing earnings at a significant pace, and it's targeting a payout ratio of 20 to 30% of earnings. So we're seeing this tremendous pace in earnings growth. They've grown the dividend over the last few payments every single time that they paid out the dividend, essentially. Things like that. There's also a renewable power company that we have under coverage as well, where they haven't been growing their dividend, but we've spoken with management, and it's something that they would like to get back to. Obviously, like, they've got some good organic growth opportunities that they need to deploy capital into, but they're looking at growing that dividend as well eventually as they increase cash flow. Something else that I'd like to mention as well, just when we do look at dividend yield, it's just kind of like a cash rich balance sheet as well, where a cash rich balance sheet can act as a little bit of a floor for a stock price, providing some support. Where if you're investing in a business that's trading at $5 and it's got a bunch of debt on the balance sheet and it runs into a year or 2 years of headwinds, well, if all of a sudden that company goes out of profitability or is cash flow negative, well, that you could see that stock go from $5 to $1 or 50 cents or even lower. But when you're dealing with the cash rich balance sheet, you can see that kind of acting as a little bit of a floor for a business. So maybe rather than going from $5 to 50 cents, maybe it's going from $5 to $2.50 or something along those lines. Again, the same thing can be said about a good dividend yield. Obviously, it needs to be the dividend needs to be sustainable. This is something that you need to analyze. But something good to note when you are investing in small caps generally.
Yeah, and
just
just marrying those two components. So what we see a lot in these dividend growth stocks is they do have a payout range. It might be 20 to 30%, 40 to 50%. If they are able to maintain that range even in poor economic times, then they do get that market dynamic. So if it goes from a 5 to 10% yield, you're going to have people shift from fixed income into those spaces. And that's why you get that lower volatility, like Ryan highlighted, over time. And that is exactly why it's just the market dynamics. If I can start to get paid 10% for a company that does cover their dividend during a time of market stress, I'm going to take that over the next hot thing that's dropped 90% and it may not make it through the next 2 years and wait for recovery. That is where that volatility being lower comes in. It's just purely market dynamics, and that's why you can actually count on it over the long term, really.
And I highlight, I had a client I was talking to last week and talking about, just the dividend, getting paid to wait and getting paid and say, well, why would I care about getting paid to wait, essentially? And it's like, over the last 18 months, market's tremendous. Everything's moving higher. You're like, why wouldn't I go chase growth? Well, there is always a rainy day, and people don't think of their portfolios like that. You need to. And getting paid, on a quarterly, monthly basis from these companies while your stocks are, going lower, because that happens in the market at times. Stocks go lower, and it will happen again. It's nice to see some cash income coming in. You can either buy something else, if you have enough, you have 20 stocks and they're generating cash every month in your portfolio, say 15 of those, then you can start to redeploy in other areas. So it is great. It is a strategy to have. It also just a management team that has to implement a dividend or pay that dividend on a quarterly basis needs to mine the store in terms of cash flow. They need to know that they need a certain amount of cash to go to their dividend every month. And if they want to grow that, they need more. And if they want to grow the business, they need more. So it imparts a discipline on a management team that isn't there. Great management teams don't need that. But some of the best management teams, it just gives you a reminder that you do need to grow that cash flow if you want to grow the dividend, and it imparts a discipline on management teams we found over the long term. So, and it doesn't have to be boring, as you can see. Like, those are two of the best performing stocks, 20 years, 10 years. If you look back, those are the returns that everybody wants when they want to find the great small caps or the great growth stocks, and they happen to be dividend growth stocks. So, I mean, there is something to the data. We need to trust the data in both of those areas, and marrying that can give you returns over the long term. Brennan was talking about cash-rich balance sheets as well. I'm going to be presenting at a conference coming up at the end of this month, where I'm going to show a case for a cash-rich balance sheet, a profitable existing business, and then using that cash balance sheet, 50% of its market cap, as a catalyst. And then I'm going to look at a new company that has, in that range, 40+% of its market cap in cash. There's catalysts coming. They can use the cash to capitalize on those. Can they be the next growth story as well? So, these are the things we look for. The more those type of businesses that you stick into your portfolio over time, the more of a chance you have to beat the market long term. That's what we're trying to do. All right. Let's.
Can I say one more thing? Yeah, one more thing is just like, it does surprise me how often we get that question of like, why would I want the dividend? And a lot of the times, clients or prospective investors will look at the return on a stock, and they won't include the dividend return that they've been earning over the past 5 years. And that is like a downfall to a lot of like self-directed accounts, is on the individual stock, it's not going to be calculating the return from dividends. If you look at like the full account, and if you look at like your full account return over a year, it will account for the dividends, because again, the dividends are essentially just getting placed right into your cash balance, on your self-directed account. Again, I'm sure that this is common knowledge for a lot of people who are listening to the podcast, but it does surprise me time and time again when I do hear that, where it's like, what happens with these dividends, and it's like, well, they get paid right directly into your account. I love going to my account statements.
They're also tax preferred if they're Canadian dividend
and
too.
tax preferred.
If it was interest, if it's at 5% dividend, you probably need 7+ to actually get the same in interest. Yeah. So sorry.
I used to always chase growth. I have learned to love dividends. It's so much fun seeing them stack up.
I mean, and we just talked about Dynacor. If you bought it in the $1.50, $2+ range on the original recommendation, you're getting paid almost 8% every year now, and we expect that to grow. Perhaps not this year, but going forward after that, as cash flow grows, they continue to grow that. You could get to 10, maybe potentially 15%, 5-10 years out, and like that's just in your portfolio every year. At 8%, even if a stock goes up 10% a year, you think it's a decent return. But then you add 8%, you get 18% every year. If a stock did that for you for 10 years, you're going to have a tremendously strong return in that company. So the dividend matters. Total return matters for sure, particularly when it's growing. I would prefer a 3% dividend that is growing over the long term versus a 5% that just sits there. And sure. You're going to, and we often are looking at like a 5+% growth in that dividend, 5% dividend is growing over time. And you can put that against another 5% dividend that's not. It doesn't have to be the 3 versus the 5. Often it's a 5 versus 5. One of them's growing, one of them isn't. Buy the growth in the dividend. All right, let's get to our first Your Talk, Your Stock. There's a Your Talk, Our Steak. I'd like a steak right now. Anyways, Your Stock, Our Take segment. It's NameSilo, an interesting company URL, Canadian Stock Exchange. Brennan, take it away. I'm going for a steak. See ya.
Okay, well, enjoy your steak. Um, so yeah, NameSilo Technologies, URL on the CSE, currently trading at a price of about $1.50. I think it actually was a little bit higher in the trading session today, maybe $1.55 or $1.58. But market cap of 132 million. It does not pay a dividend, and they are a low cost provider of domain name registration and management services with over 5.8 million domains under management and customers from approximately 160 countries. They are one of the largest domain name registrars in the world. It has grown its domain names under management from approximately 745,000 domains at the beginning of 2017 to over 5.8 million today. And they indicate that they maintain a customer retention rate of approximately 55%. Now, we've monitored NameSilo for some time, but despite its good top line revenue growth, we really struggled to like the business given its inability to generate meaningful earnings per share, or EPS, or earnings per share, which in my opinion is why the stock had essentially sideways traded for several years. But more recently, you can see here the stock has performed very strong over the past 12 months, up over 380%. So let's take a deeper look at the business here and see what is driving the tremendous run. Now, just to go over some operational updates first, on September 12th, the company entered into a definitive share purchase agreement to acquire Sewer VUE technology for 2.45 million Canadian. This is a company which specializes in large diameter pipeline inspection technology, and this will now allow NameSilo to provide inspection services to clients in the municipal, mining, and engineering sectors. Now, the company does make investments in other companies, which I'll show you in the future slides here. But I find it a little peculiar that a domain registry company is getting, into the pipe penetrating radar business. So, with this said, they are almost more of an investment company to some degree than just a domain registrar. So keep that in mind. And the next acquisition, or the recent acquisition here, which they made, was for shorturl.at, which is a free tool to shorten URLs and generate short links. I could not find any disclosure on what they paid for the business. Maybe there is something out there. Commented in the in the comment section under the YouTube if you can find that. So now that I've already mentioned that the company has several investments, you can see they own own positions in several companies, including names which we have covered on the podcast before, like Atlas Engineered Products, or AEP, on the TSX Venture. They also have investments in associates of over 1 million on their balance sheet, including Ola Media, which is a digital media company focusing on touchscreen displays in ride-share vehicles, as well as Alchemy Labs, which is a leading nanotechnology-powered industrial coatings company focused on the automotive and defense sectors. But from the equity losses on the right-hand side here, you can see that the businesses are not profitable, which is reducing their investment line items. And as well, you can see that the company from this slide, that the company has exposure in digital currency, including Bitcoin, Ethereum, TRX, POL, and some USD stablecoins. So while we're on the note of the balance sheet, you can see here that they have, again, just kind of going over what we went over on the last slide here. They have 1.1 million in investments, as well as investments in associates for over 1 million, which again are the two names which I described earlier, and 1.3 million investments in digital currency. But one thing that I did not cover on the last slide is that they also have an investment in a joint venture with SAW Technologies, which again you can see as a line item on the balance sheet here. I'll also note that they do have some note receivables from these companies, which it invests in as well. So it is earning interest from these companies. Now, the cash position on the balance sheet as at June 30th, 2025 was solid, with a net cash position of 3.6 million, or 4 cents per share. And the company has slowed its aggressive pace of increasing or issuing shares. You can see that big jump up at the beginning or end, I guess, of 2020. Now, moving over to more of the financials, Q2 2025 ended June 30th, 2025. Revenue was up 22% due to an increase in domains under management, marketplace revenues, and sale of ancillary services. The company has also been able to produce some better EPS over the last couple of quarters that you can see there. And bookings year to date, so this is adding up Q1 and Q2, were up 9% year over year, which is good. And looking a bit deeper on the quarter, gross margin was up to 26% of revenue from 22% in Q2 of 2024, which I believe I read somewhere that it's the ancillary revenue boosting margins. The business also produced adjusted EBITDA of 1.5 million, up over 100% year over year, and net income was 1.2 million or 1 cent per share compared to a gain of 225,000 or essentially break even on an EPS basis in Q2 of 2024. And you can see that under the other items, the business was generally negatively impacted with a loss on foreign exchange, a realized loss on some crypto. Overall investments in financial assets were down. I think like Atlas Engineered Products price did come down as well. That's probably driving that a bit. And we can also see that their loss from equity pickup was negative, which again is from their investments in associates. Looking at the valuations, trailing price to earnings ratio of 75 times, trailing price to cash flow of 16 times, and a trailing enterprise value to EBITDA multiple of about 32 times. So despite the company's good long-term revenue growth and getting more into meaningful earnings per share, I would argue that the company is currently pricey. And realistically, I'd like to, get an adjusted EPS figure here as well, and really get more of an idea on, kind of normalized EPS, taking out the swings in fair value of their financial assets, etc. So to conclude on NameSilo, NameSilo is a domain registry business, but also an investment holding company, essentially. The balance sheet remains strong with net cash per share of 4 cents. The company continues to make acquisitions and deploy capital on investments. So the question that I would raise is, do they not have any good options to maybe reinvest in the domain registry business directly? And, I'll also note that they have been investing in unprofitable businesses as well, which, is decreasing their investments in the company. Financially, Q2 2025 marks the company's 11th consecutive quarter and 7th year of consecutive revenue growth, as well as the business has been increasing operating income and cash flow. So I really think that this is what's been driving the stock higher. But the business does trade at elevated valuation multiples, in my opinion. So I do not think that it would be a bad idea, if I was management, to raise some capital at this level, if they're looking to continue to deploy capital. But nonetheless, I would argue that the current valuations are a bit more on the pricey side. Now, I don't think that it's a bad business, but it does remain a monitor in my eyes. The stock has done tremendously well over the last year, and the financials are improving, but it is an entity with its fingers in many pies, which makes it more of a complex entity to analyze. And of course, here are those pies that I made for Friendsgiving earlier this weekend, because everyone who just heard this financial analysis cares so much. And this is the disclosure. We do not have a position in the business.
Thanks for ending with the pies. Yeah.
yes.
Good long-term revenue growth, inflecting into profitability, which is nice to see. The valuations on a price to cash flow basis are a little rich unless that growth continues and the inflection continues significantly. That's just our quick review. And I hope that answered the question. Brett, did you have any comments on that, or should we just move to the recent IPO that you're going to look at, Klarna?
Yeah, we can move to
Swedish fintech.
Klarna. Swedish fintech.
Fish is what I think of.
I can't say it's as delicious as Swedish fish,
No,
unfortunately.
It is not. It's a dish, a Swedish fintech that we got nothing. Just keep going.
Yeah.
Klarna. Yeah, I mean, interesting fintech, that part of that, buy now, pay later movement.
Yeah, it's really been that shift in the subprime space to shift to these break up into 4 payments. Affirm's another big one, which competes against Klarna, Afterpay. There's, I assume, quite a few other ones internationally as well. So it's just really that shift from traditional lending where it's whatever, few months to a few years type of personal loan to these individual purchase loans. But Klarna, symbol CLAR on the New York Stock Exchange, they recently IPO'd. The IPO just taking place on September 16th. We're recording about a week after that. Klarna is a Swedish fintech company that provides buy now, pay later services, and they are known for breaking up consumer purchases into 4 interest-free payments. That is their bread and butter. The company has 111 million active consumers with 790,000 merchant partners with 112 billion in gross merchandise value served over the past year. The company had an IPO share price of $40, but the opening trades took place around actually $52, but fell throughout the day. And then throughout the rest of the week or following days, it fell as well. And now we're trading about 43.68, resulting in a 16.6 billion market cap. Despite just IPOing, the company has been actually around for 20 years, and this wasn't the company's actually first attempt at an IPO. It had previously been looking and scoping out to IPO in 2020 at a $45 billion valuation, which is substantially larger, obviously nearly 3 times. Then that was based off of prior private raise valuation. So someone actually did pay for a $45 billion valuation, where the IPO was about $15 billion. Once it actually IPO'd, nearly 4 years later after that private raise. So the IPO prospect documents boast really a high addressable market of over 1 trillion. The group highlights some of high growth figures like 19% growth in merchandise value, 31% in active user counts. The selling point to consumers is really interest-free flexible financing, where the value proposition for merchants is to offer Klarna is to increase transactions and higher average order values. Effectively, if people are able to spend more money, they will, and that benefits the merchant. The group emphasizes the quick underwriting time, with underwriting decisions taking seconds, as well as the ability to scale technology. But it's an IPO. They like to talk up, they like to market. Do the financials actually have any legs to it? For the last quarter, so that's Q2 for ending June 30th, the company had revenue of $823 million. That's up 21% from $682 million in the prior year, roughly tracking that gross merchandise value increase as well, with $604 million of that revenue being from transaction and service revenue, which is primarily those merchant fees. Effectively, they take a percent of the finance amount. So if the payment for the product is $100, Klarna will instantly pay the merchant $98, which means they get $2 in transaction revenue. As well, including in that segment or a line item is advertising revenue, where Klarna promotes certain merchants, but that is not the majority of it. The other revenue class being $219 million in interest income, which, although most transactions start under interest free, if they're not paid on time, they do start to accrue interest. But 8% of the overall merchandise value was under their fair financing line, or what they call it, which is more of a traditional financing option with longer duration of 3 to 48 months with interest payments, a standard consumer loan. Highlighting some key expenses, transaction costs being processing and servicing costs of $187 million, provision for credit losses, or commonly known as PCL, of $174 million, and funding costs of $147 million, for total transaction costs of $508 million, which results in what they call a transaction margin of $315 million, or 38%, down from 45% on a percentage basis. Transaction margin dollars increased 4% on a like-for-like basis, which is not as impressive as those other growth figures, meaning the company isn't seeing this surge in economies of scale at the transaction level. After operational expenses, the company had operational loss of $46 million, and even on an adjusted basis, which removes share comp depreciation, the company only had a profit of $29 million, or an adjusted profit margin of 3.5%. That's pretty thin margins. The company had a GAAP net loss of $52 million, or 14 cents per share, which is a quarterly regression year over year from materially break even in the prior year. The group is subject to Basel III, taking deposits from across Europe, and notably not in the US, however, as they do not have a US banking license. They are funded well, though. They have a CET1 ratio of 15.1% and a Tier 1 capital ratio of 17.3% as of the last quarter, which is well above the required rates and just generally, even compared to the rest of the industry, that's well funded. As well, the company did raise $222 million, which was after the quarter's end, so that'll be further to support the capital structure. So well funded as far as that concern is. But as well on the balance sheet, there is a bit of a concern for allowance for credit losses, or ACL, as in prior years the allowance was well below the level of write-offs, and effectively what the allowance for credit losses is what your expectations for these write-offs are, where in prior years the actual write-offs were quite a bit above the ACL. But now in this last 6 months, it's at 3.9% for the ACL and 2.8% of the write-off. So that does look good, but on a longer term view, it hasn't looked as lining up as how you should expect it. So that is something you just want to really keep your eye on. Management does attribute the decline from that 8.1% of write-offs in 2022 to the current 2.8% is due to underwriting maturation and scaling, which is a positive, and that is good. You just need to see, is that being reflected properly, or are their expectations just still off? But that spread between the write-offs and ACL is a key aspect overall to keep your eye on. Switching to valuations, the company trades at 5.5 times sales, which is below close competitors, a firm 7.5 times. But in isolation to the fundamentals, I would consider it still quite expensive for the significant growth baked in at a 5.5 times sales. And in contrast to the general consumer lending space, it is more expensive. So outside of the more fintech-like companies, for example, we have a consumer lending company under coverage that actually does have even higher growth rate, and it trades at 1.8 times sales. And it is profitable, and it does have that growth behind it. So Klarna is quite expensive when you're looking even on a sales basis. And if we look at some non-standard metrics, since it isn't profitable on a GAAP basis, price to transaction revenue, which is effectively price to gross income, is 13.6 times, meaning if no SG&A, no depreciation, R&D, or tax occurred, it would be valued at about 13.6 times. Further, if you looked at the adjusted operating income, since it is above break even, its price is at 109 times, which is relatively meaningless, but it's near break even, so you do get those big figures. But it is not a cheap company in comparison to the larger consumer lending space. It might be to a firm, but not the larger space. So, concluding, the stock has wanted to IPO for a long time and came in well below the private valuations of 2021. Those were crazy times, but it is still actually quite expensive. Transaction dollar growth is not as high as the non-financial metrics like gross merchandise value or active client growth. So we need to see a positive trend in financials. We need to see that conversion from just the client count or the consumer count and the gross merchandise volume into actual profitable lending. Because as for lenders, they can increase their top line actually quite easily by lending at attractive rates, but that does not inherently mean it's going to be profitable. That is a game lenders can play, is they can easily increase their top line, but that normally means their bottom line will actually start to decrease or stay flat. The top line is not as meaningful on a growth basis if you cannot produce profitability, and we aren't really seeing that at this time. And to support the current valuation, we do need to see that conversion taking place. So for now, we will continue to monitor Klarna, and as far as disclosure, we do not have any relations or position in the company.
And vice versa, they can slow growth, to, expand margins, correct?
Exactly.
And this is like, there was a survey, according to a recent survey from Lending Tree Survey, they said that 25% of individuals who are using buy now, pay later are using it for groceries. And this is something that I found interesting, that, a lot of, like, they're lending it interest free, like you said, as long as they're paying on time. So as for an example, like, this is from the New York Times, an article from June 2nd of 2025, talking about that Lending Tree survey. They said when Tia Hoge stocked up at her local Kroger in early April, her bill was nearly $400 at checkout. She scanned her app from Klarna, a buy now, pay later company that offers short-term loans. Klarna paid the grocery store for the 71 items in the cart. Miss Hoge split her payments to Klarna into 4 installments of about $100 with 0 interest. Again, when I was hearing like a lot of buy now, pay later, I was always thinking that they're getting charged interest on it. But, it makes a sense, just how you explained it. If, all of a sudden it's, $100 in groceries, Klarna will pay them, $98 essentially. Is that,
Yeah, and
then
that's
they'll
about
get 100.
75% of the revenue as well.
Yeah,
So
yeah,
it's really just receivable financing if you want to look at more traditional terminology more than merchandise fees. And that's how I would personally like to see that.
yeah.
Yeah, interesting. Again, good growth in the revenues, just not profitable. It just wouldn't make our initial criteria. There are other names in that field right now that are growing either at the same rate or maybe a little bit less, a little bit more, that are profitable. So we'll take a look at those names until Klarna is profitable, and its valuations relative to some others seem high. Often you see an IPO, some excitement, and then we'll see if we can
We'll see how
track.
it does in a few years.
Yeah, we'll see how it does in a few years, and maybe there's an opportunity then. But right now, at what is it, 5.5 times sales, and unprofitable. I mean, just doesn't work in terms of our evaluation metrics that we would look at for a business. High risk is what you are taking on investing in a company just with that profile. All right. I think that's going to end our show for this week. If wherever you are watching this, you're watching us on YouTube, you smash that subscribe button. If you're listening to this, wherever you consume your podcast, rate and review us. Keep your questions coming in to our Your Stock, Our Take segment. We'll endeavor to answer those on a weekly basis. And as always, I wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.